With mortgage rates lower than they've ever been before, is now the right time for you to refinance? Or should you stick with the loan you've already got? Hello and welcome to Practical Personal Finance, where you get the information you need to understand and succeed with money. I'm Andrew Shear, and in the next few minutes, I'm going to teach you about the concept of refinancing a mortgage, the 3 different types of refinances, and how to determine whether or not refinancing is the right choice for you. Make sure you stick around until the end for an important piece of advice that may help you avoid accidentally committing mortgage fraud. If that all sounds good, then give this video a blue thumbs up. And if you're new to the channel, hit that red subscribe button. You're about to learn something new about money. Let's start off by laying down some general terms. When you're refinancing any type of debt, what you're essentially doing is taking out a brand new loan and immediately using the money to pay off your old loan. That new loan could be with a new lender, or it could be with the same lender you've got now. Refinancing a mortgage specifically is no different. You're taking out a brand new mortgage loan and using it to pay off your current mortgage loan. The process of refinancing a mortgage is very similar to the process of getting a mortgage in the first place, but there are a few subtle differences. For an insider's perspective on what to expect, I asked Grace Maxwell, a senior mortgage loan officer with George Mason Mortgage in Richmond, Virginia.
It is pretty similar. There are a few differences. In general, it's still a loan. It's still going to be held with a deed of trust on a piece of property. And it's still held to more or less the same underwriting guidelines. So we're required to prove mostly the same information on a refinance as we are on a purchase. I find sometimes when it gets into those situations where the underwriter is making a judgment call, for example, a refinance, you're going to get a little more slack because they can see, hey, they're already making the payment on this and they're doing a great job. This is probably a lot less likely to come back on me than a purchase loan where they don't have anything to show that you're making the payment.
There are a number of reasons you might want to refinance your mortgage. Maybe you want to take advantage of an opportunity to lower your interest rate. Perhaps you want to tap into the equity in your home to pay off other debts or do some renovations. Or maybe you want to change from a variable interest rate to a fixed interest rate. In any of these situations, refinancing could be a great solution. It's important to keep in mind, however, that refinancing a mortgage, unlike refinancing certain other types of debt, is not free, despite what you may see advertised.
If you're not paying for it with your credit card or in your closing costs, you're paying for it in your rate. Because all of us lenders get our money from the same places and we all sell our loans to the same places. So when you talk about, these advertised loan rates and these advertised no closing costs, it's like the BMW dealership saying that you can get a brand new 5 Series for $350 a month. Theoretically true, unlikely to be a good idea or realistic for most people. So there are costs, and anyone who tells you that there aren't is not doing something in your best interest. Your city or county is going to charge for recording that deed. They're going to tax you for recording that. You're going to have to pay an appraisal, and generally the loan mortgage company is going to have some kind of fee.
There are 3 different types of mortgage refinances. Each of them follows the same basic concept that we just discussed in part 1, but each type serves its own specific purpose. The most common type is called the rate and term refinance. Then there's the cash out refinance. And finally, there's the fairly uncommon but still worth mentioning cash in refinance. What makes these 3 types of refinances different is the amount you owe on your new loan compared to the amount you owed on your previous loan. First up is the rate and term refinance. This is the most common option. In a rate and term refinance, your new mortgage is for the same amount as your previous mortgage. The only things that change are the interest rate and the term, or the number of years remaining until the mortgage is paid in full. If you want to save money on interest in the long run, or you want to switch from a variable interest rate to a fixed interest rate, the rate and term refinance is for you. In part 3, I'll go over the concept of a break-even analysis, which will be especially important for this type. Next, we've got the cash out refinance. This option is not as popular as the rate and term, but it's still very common. In a cash out refinance, your new mortgage is for more than the amount of your previous mortgage. Now, at first that might seem like a bad deal, but don't worry, you're not getting ripped off, because your new mortgage lender will give you a check for the difference. What you're doing is taking cash out of the equity you have in your home, which is why it's called a cash out refinance. The interest rate on a cash out refinance is typically a little bit higher than for a rate and term refinance. But if you want to tap into the equity you have stored in your home, this is one way to do it.
A cash out can pay off any number of things. So when people come to me, sometimes they say, I need to lower my monthly payment. I want to do a rate and term. Well, if you're 10 years in your mortgage, you're now taking a new 30-year mortgage. So sometimes I say, let's look at your budget. Why do you need to lower your payment? Oh, I have $400 in monthly credit card payments I'm paying on. Well, sometimes it might make sense to change that refinance into a cash out and pay off those. And then we'll do the numbers on how we can pay your loan off faster and work on your monthly budget. So you want to get a loan officer who takes the time to ask what your goals are and doesn't just check a box and move on down to the next limit.
Last but not least, there's the cash-in refinance. This type of refinance is fairly uncommon these days, but it's still worth understanding. With a cash-in refinance, your new mortgage is for less than the amount of your previous mortgage. That's because in the process of getting this new mortgage, you're adding some money to the pot. There are a few situations where a cash-in refinance might be a good option. Maybe you're trying to get to 20% equity so you can eliminate private mortgage insurance. Maybe having that extra equity helps you secure a better interest rate. Or maybe, as was common back in the early 2010s after housing prices declined, you wanted to refinance but couldn't do so if the amount left on your mortgage was more than the current value of your home. In any of those situations, if you have the cash to contribute, a cash-in refinance would be a great choice. Finally, let's talk about how to determine whether or not you should refinance your mortgage. This part is going to involve just a little bit of math, but don't worry, I'm going to walk you through it nice and slow. And when it comes time to apply this math to your situation, you're going to have some help. As Grace mentioned earlier, refinancing a mortgage is not free. You're going to have to pay for closing costs to get the deal done. That includes things like appraisals, attorney's fees, loan origination fees, and local taxes. All of that can add up to thousands of dollars, but when you end up saving even more money in the long run, that makes it all worthwhile. To calculate whether or not it's worth it to refinance, you need to do what's called a break-even analysis. To make things simple, let's say you have a mortgage with $200,000 and 20 years remaining, and your interest rate is 5%. So you'll take $200,000 and multiply by 0.05, and you end up with $10,000 per year in interest fees. You have the opportunity to do a rate and term refinance with the same 20-year term, but a lower interest rate of 4%. If we take $200,000 and multiply by 0.04, your new interest rate, you end up with $8,000 per year in interest fees. That's a $2,000 per year savings. Now let's say your closing costs come out to $6,000. So you have to pay $6,000 to get the refinance done. But once that's out of the way, you're going to save $2,000 per year in interest. Divide $6,000 by $2,000 per year, and you wind up with 3 years. That's your break-even point. If you stay in that house and keep paying that loan for 3 years or more, you just saved yourself some cash by refinancing. But if you change your mind and move out after a year, you just lost yourself $4,000. Unfortunately, until you do the math with the closing costs and new interest rate, there's no way of knowing exactly how much you'll save and when your break-even point will be. So it can be tough to know if refinancing is something you should pursue without first talking to a mortgage professional. Here's some advice from Grace on when it might be a good idea to take that step.
It's really going to come down a lot to your loan amount. The higher of a loan amount and the longer you have left, the more sense it's going to make to refinance. You can also always look at refinancing into a 15 or even a 10-year note if you don't have that long left. I do have a lot of clients right now who are taking a little interest savings on a 15-year. Right now, I would say on average, if you got a loan 10 years ago and you have 20 years left, most of my clients can refinance into a 15-year, and with the interest savings, their payment does not go up. So maybe your goal isn't to lower your payment, it's to shorten the term.
There's one last thing you should know before you go and refinance. and it could save you from unintentionally committing mortgage fraud. When you're refinancing a mortgage on your primary residence, i.e., the home you live in, the interest rates will typically be lower than when you're refinancing a mortgage on a home you do not live in, i.e., an investment property that you rent out. And if you plan to buy a new home to live in and keep your old one as a rental, the rules can get a little tricky.
If you are going to turn your current house into an investment property, you're going to start renting it out. You're going to sign an affidavit at closing that says you intend to occupy that house for 12 months. If you're doing that refinance as a primary residence, which is going to have the best rate and terms. If you sign that affidavit and do not intend to occupy for 12 months, technically that's mortgage fraud. We can get into whether or not someone feels comfortable committing mortgage fraud. If I know it's happening, I have to pump the brakes and say I'm not originating this loan. However, if you were to go ahead and do that with somebody who was comfortable with that and you knew you were turning it into a rental, your next mortgage that you get is going to be an absolute nightmare to get approved. And that's because the underwriter sees you just refinanced this house. Okay, so you said you're going to occupy it for 12 months. What happened?
If you're looking at refinancing, having an honest, patient, and knowledgeable mortgage professional is an absolute must. So don't be afraid to shop around until you find the one that's right for you. If you keep your shopping to 45 days or less, you can minimize the damage to your credit score from the number of inquiries. I want to thank my friend Grace Maxwell for taking the time to answer my questions about mortgage refinancing. If you're considering a refi, I would encourage you to listen to our entire 15-minute conversation on the Practical Personal Finance podcast. It's available right now on Apple Podcasts and Spotify. And if you've got a question for Grace, you can contact her using the link down below. She is very passionate about mortgages and is eager to help no matter what your situation is. Have you ever refinanced your mortgage? What was your experience like? Any advice? Let me know in the comments. If you enjoyed this video, you'll love my video about the mortgage interest tax deduction. Click right here to watch. And if you're not yet a PPF subscriber, then click right here to hop on board. As always, thanks for watching. I'm Andrew Shear, and I'll see you next time.